Hi guys, welcome to my YouTube channel. My name is Michael Mansaliova. I'm going to look at this presentation involving flexible budget under cost and management accounting. The presentation outline is as follows. We shall go through introduction to flexible budget, then look at components of a flexible budget, look at how do we create a flexible budget. We shall look at benefits of a flexible budget and look at the implementation and monitoring. Finally, I'll look at a worked example of a flexible budget. Flexible budget can be taken to be a budget that is designed not to change with changes in activity level. It's a financial plan that adjusts as activities levels change, hence providing a dynamic tool for performance evaluation and cost control. For its purpose, you can say that it helps make informed financial decisions in a dynamic business environment. That's what the purpose of the flexible budget is. Components of a flexible budget. The elements which you are going to identify in the flexible budget include fixed costs, it includes variable costs. You shall find semi-variable costs, and there will be activity levels indicated. How do we create a flexible budget? I've provided simple steps that needs to be followed to prepare a flexible budget. The first step you need to undertake is to determine the base budget. The base budget is what can be referred to otherwise as a fixed budget. This is a budget which is designed not to change with changes in activity level. Second step is to identify the cost behavior. Find out which activities are affected by changes in activity level in terms of costs, and those which do not change with changes in activity level. In other words, find out which are the variable costs and which are the fixed costs, and in certain cases, find out where you have mixed cost arrangement. Step 3. Establish the activity level. Step 4. Then calculate the flexible budget figures. What are the benefits of a flexible budget? The first benefit I can talk about is that it leads to improved decision making. Where you got a yardstick or a benchmark and you see the process of budgeting, you are able to identify the behavior of costs. You know that if you leave to increase activities to a certain level, there will be an effect on the cost. You need to know when you make a decision, whether that particular decision will lead you to blow out of relevant range in terms of costs or not. Therefore, if you are able to do that with the use of a flexible budget, it will indeed help you improve decision making. We also have enhanced cost control. Of course, when you have prepared the budget, it is used as a benchmark to help you determine whether you are underperforming or overperforming, or indeed whether you are within the cost constraints or you are trying to go or depart from the limits of cost. The third advantage is that it may lead to accurate performance evaluation. Where you have come up with a flexible budget, you have actually looked at a creation of a budget given that the activity level could have changed, okay, and you are looking at what would the budget look like if it was prepared at the changed level of activity. In this particular case, you are looking at comparing actual results with a flex budget result at the same level of activity. This actually leads to an improved performance evaluation. The fourth one is adaptability to changing conditions. The flexible budget is designed to change with changes in activity level. So that's how it falls into this place. The last one, but not the least, it enhances communication. Any budget preparation process involves coordination, and the budget does help to communicate the aspiration of the organization to any member of that particular organization. So it enhances communication. How do we carry out the implementation and monitoring of a flexible budget system? It involves establishing budget variance analysis, where you are looking at the differences that you are going to see or experience when you have departures from the fixed budget. So you need to understand or analyze what could have led to that particular difference. In the process of doing so, you are carrying out what is known as budget variance analysis, so that you can learn from the past experience to improve the future budgeting. It also can be said that you need to have regular review and adjustment. When you prepare a budget, you do so with certain conditionalities in mind, but over time you find that these particular conditionalities do change. Okay, so when they change, they might become a factor which can not make your budget very useful. So in this particular regard, you need to hold regular reviews to see what changes have taken place and assess whether change or adjustment need to be made for the budget to remain relevant. The next can talk about in the implementation and monitoring is setting up of responsibility centers. A responsibility center is an operational unit or entity within an organization that is responsible for all activities and tasks structured for the unit or for that unit. These centers have their own goal, they have their own staff, they also set their own objectives, policies and procedures, and financial reports. We also need to be cognizant of the fact that these days you can make use of software tools to help you in the implementation and monitoring procedures. I want to look at a worked example on flexible budgeting. To do that, I'll use this example to deal with ABY Limited. ABY Limited. Let me just make an adjustment there. ABY Limited. Okay. ABY Limited uses a flexible budgeting control system in assessing its performance. The following details are available for the period 1st January 2023 to 31st December 2023. So you have the fixed budget, otherwise known as the base budget, and then you have a column which shows the actual results, what has actually taken place. You have the production units or production and sales units. Under base budget, it's reflecting 500,000. That's what you plan to produce and sell, and then you find that you actually sell 700,000 units. The sales revenues are given here with 890 million for fixed budget and 990 million for actual results. You have the direct material, direct labor, direct expense, variable overheads, production overheads, which are given as 60% variable, meaning the 40% component of this figure is fixed. We look at the other part, tells you depreciation, which is fixed, rent and rates also fixed, other overheads also fixed, management salaries fixed. What is the task before us? We are required to prepare a flexible budget performance report for the period ended 31st December 2023 to be presented to management. So that's the task we have. Now, when you are preparing a flexible budget, especially in an exam situation, what you should do if the question is phrased in this manner or structured in this manner is to copy the fixed budget and the actual result together with the details here, and then add 3 more columns. One column will cover the flex budget, the other column will cover the variance, and the third column will cover the remarks or comments. So that's what we're going to see. So given this task, the preparation will be presented as follows. So as I've said, you have the narrative, the descriptive part, you have the fixed budget, the actual result, flex budget column, variance column, and we have the remarks column or comments. Okay. So I've said that you have to copy everything that the question is showing you in terms of fixed budget and actual results together with the narrative part. Then you add just these 3 columns. So now I'm going to show you how you flex the budget. To flex the budget, you have to set the activities at the actual results level. In this case, if you look at the question, you have actual results 700,000 units. So that is the level of activity which we set for flexible budget. So you put 700,000 units here. Okay. Then now you have to generate these values. Remember, you have to identify the cost behaviors or the cost drivers or revenue drivers. Okay, so in this particular is the production unit, and what happens to this? Look at the type of cost we have. If you are looking at the cost, the direct material are more like variable costs, which means these are costs which change in direct proportion to the level of activity. So if that's the case, together with the revenue also increase in direct proportion to the level of activity, level of sales, volume of sales. So in this particular case, we can generate what was the unit selling prices or unit cost. How do we do that? Let me start with the sales revenue. For you to generate the unit selling price, the budgeted selling price, you look at the fixed budget column, look at the budgeted sales, which is 890,000. So 890,000, you need to divide by the activity level, which is 500,000. It simply means that in this particular case, let me just give you some bit of workings. In this particular case, you have the 890,000 or 890 million. You divide this by 500,000. Okay. 890 million Zambian kwacha divided by 500,000 units. Okay, so what you are going to get is, get the calculator. You have 890,000 divided by 500. Okay, so what are you going to get? 1.78. okay, so you multiply this 1.7, you multiply this one by what you've got here, the new level of activity, which is 700. So if you multiply by 700,000, you are going to get the 1,246,000 kwacha as a new sales revenue under flexed budget. So that's what you do. You get the kwacha value divided by the quantities, you get the selling price per unit, then multiply by the new unit level at the flex budget of 700,000, you get 1,246,000 kwacha under flex budget. You come to the cost, the same is followed. You get 200 million kwacha divided by 500,000 kwacha. So you get 200. Okay, get 200 divided by 500,000. 500. So basically you are getting the cost per unit of raw direct materials. So if you know it is that 40 ngwe or 0.4 kwacha, you multiply by the number of units at the flex budget, which is 700. So multiply that by 700,000. You are going to get 280,000. So that's how I get this 280,000. The same with direct material, because this again is the variable cost. So it means that it changes in direct proportion to the level of activity. So you get the whole 120 divided by 500,000. The cost per unit of labor which you get, you multiply by 700,000, you are going to get 168,000. Direct expenses, the same approach. You get 50,000 or 50 million in this case, Zambian kwacha, divided by 500,000 units. You get the direct expense per unit. Then multiplied by 700,000, you are going to get 70,000 kwacha. Variable overhead, the same will be done. You get 100 million divided by 500,000. You get the variable cost per unit, then multiply by 700 units to get the 140,000 kwacha, 140 million kwacha, Zambian kwacha. Okay, so that's what you do. Then the next thing you look at is the production overheads. Under production overheads, you are told it's 60% variable, which simply means that this figure you're looking at has 60% made up of variable costs, and the other portion, which is 40%, is made up of fixed costs. So how do we do that in order to flex the budget? So that's what I'm going to show you. Okay, again we get back to this working page. Okay, look at the working page. We have been told the total cost, which is the mixed cost of variable and fixed costs. Total cost is given as 50 million kwacha. 50 million kwacha. That's what we have. 50 million kwacha. That's what we have here. 50 million kwacha. There are 3 zeros on top, so it's 50 million kwacha. So we are told it's 60% variable. So meaning that part of this is fixed. So fixed cost, which is 40%. Fixed cost is 40%. That's what we have. Fixed cost is 40%. So that's what we have. So now, what is this 40%? So if you work out 40% of 50 million as given, you are going to end up having, let me just make it bigger. Okay. Okay, something like that. Okay, this is too big. Okay, that is that. We are going to end up having a figure of 40% of that, which get to the calculator. 40% is the same as 0.4 multiplied by 50 million. Let's make use of this. We're going to get 20. Okay, so there will be 20 million. So this is 20 million. Okay, so meaning the difference between these two this one. Oh, no. Okay, fine. The difference between these two will give me the difference, which is variable cost, which is 60%. Which is 60%. So we're going to get the difference is variable, which is 60%, as in 30 million. Okay, 30 million. Now, once we have got the variable component, then we can go ahead and find out what the variable cost per unit. Okay, variable cost per unit. So we get this 30 million divided by the 500,000 units under fixed budget. Okay, 500,000 units under fixed budget. Okay, what is going to give us? So this let's say this is get 30 million. Which is 30 million. Okay, this divided by 500,000. Okay, we're going to get this as a variable cost per unit. This will be the variable cost per unit. So variable cost per unit is found to be 30. Okay, 60 rather. That is 60. Yes, indeed 60. So once we've got this 60, we now find what is the variable cost at 700,000 unit level. So you multiply total variable, get total variable cost at 700,000 unit level. Okay, so meaning that you multiply by 60. Okay, so if you multiply that by 60, 700,000, you're going to get 42 million kwacha. It will give you 42 million kwacha. 42 million kwacha. Now don't forget that this is just a variable component at the unit level of 700,000. Now remember, we are trying to come up with the mixed cost at 700,000. We dropped off the 20 million because that is a fixed cost, so that we remain with 30 million to generate the variable cost per unit. Then we multiply 60 by 700,000 to get the 42 million. Now we have to complete the equation. Remember that we have just the variable component, but we need to add to it the fixed component. Now fixed component, the principle is that fixed costs do not change regardless of changes in activity level. We have changed the fixed cost from the level of activity from 500,000 to 700,000 kwacha. What changes between the cost is the variable cost. The fixed cost does not change. So we bring the fixed cost intact as before. Fixed cost we bring it as before, which is 20 million, so that we end up having a total of which is fixed plus variable. That will be 62 million kwacha. 62 million kwacha. So that's what we have when we add these two. We have add these two, we have 62 million kwacha. This 62 million kwacha is the total mixed cost at the new level of activity of 700,000. So you have 62 million kwacha here, 62 million kwacha here. That's what we have here. Okay, so now then we move on to look at the other portion. It says depreciation fixed, rent and rates fixed, other overhead is fixed, management salary is fixed. So what you do is that since fixed costs do not change regardless of the changes in activity, you just copy the way they are under fixed budget and paste them under flexible budget the way they are. Because here at fixed budget the level of activity is 500,000, flexible budget the level of activity is 700,000. Now the fixed costs are not expected to change with changes in activity level. That's why we just reflect the same figures. Okay, so now we have generated all the figures that we need under flexible budget. We have generated all the figures we need under flexible budget, the cost together with revenue. Then we need to look at the variance. The variance is simply the difference between the actual result and flexed budget. So we find between flexed and the actual result, under sales revenue there is a difference of 256,000. Now we have the remarks column here. The remarks column should indicate whether it's an adverse variance or favorable variance. So in real life, under the remarks column, this is where the divisional manager has to give a more elaborate report giving explanation as to what could have led to this variation. But for academic purpose in the exam, what is expected is you to just indicate adverse or favorable. Adverse, it means that it's not good. Favorable, it is a good. So in this regard, when you look at between the difference between actual result and flexible budget, the difference is 256. We are saying here that we should have made or raised 1,246,000, but we only raised actually 990 million. It would have been 1,246,000,000, but we only managed to generate 990 million kwacha. So we are short of 256 million kwacha. Since we are short, it is bad, therefore adverse variance. We get to the direct material again. The budget was indicating that we are supposed to spend 280 million kwacha, but we only spent 250 million kwacha. Therefore, since we spend less than what we were supposed to spend, we saved on cost to the tune of 30 million. This is good, therefore it's a favorable variance. We go to the next one. We should have spent 168, we only spent 150 million, therefore we saved 18 million. This is again favorable variance. The next one, we should have spent 70 million, we only spent 40 million, we saved 30 million. This is favorable variance. The next one, we should have spent 140 million, we overspent by 5 million when we spent 145 million. So this 5 million difference is adverse. The next one, we should have spent 62 million, we only spent 60 million, we saved 2 million. This is favorable variance. We move on to the next one. Under depreciation, we should have spent 30 million, we spent more, we spent 35 million, therefore 5 million adverse variance. Under rent and rates, we should have spent 40 million, we spent actually 42 million, so overspent by 2 million adverse variance. Under other overheads, we should have spent 20 million, we overspent, we spent 24 million, the 4 million difference adverse variance. Under management salaries, we should have spent 60 million, we spent 58 million, we saved 2 million. This is favorable variance. Therefore, the total expenditure, if you add under fixed budget, the total expenditure is giving us these values. Okay, that is the total expenditure. So we compare the total expenditure under fixed budget against the total revenue. So 890 million minus 670 million gives us a profit of 220 million. We do the same under actual results. We look at the actual of 990 million minus the total expenditure of 804 million, giving us a difference of profit of 186 million. We go to the flex budget. The flex budget showing that we should have made 1,246,000,000 against the cost of 870 million. So we expected to make a profit of 376 million. So here there's a difference of 190 million of profit. So when you look at the variances, we have 256 million adverse, 256 million adverse, 256 million, 256 million minus 66 you are going to get 190 million. So these are the, when you look at the costs alone, the costs alone give us a net position of 66 million favorable. The cost alone gives us a net variance of 66 million, which is favorable. When you add and subtract the cost variances starting from here and the cost starting from here going down, okay, so what you see for favorable is more like a positive, adverse is more like a negative. So you add the positives, subtract the negative, the end result you are going to have is a positive of 66 million favorable. Once we have the total position of the net position of variances under cost, look at the net position of variances under revenue. Under revenue, you have a negative or an adverse variance of 256, more like a negative. So compare it with the cost variance of 66 positive. So means that the 66 positive cancels the 66 from the negative total of 256, leaving you with a negative of 190. So adverse net position of total variances is 190 million. That is under the profit. So that's how we work out the flexible budget in this particular regard. I've shown you some of the simple workings and I've guided you how to come up with a flexible budget in this particular report. Thank you for listening. Please don't forget to subscribe to my channel and like my videos. See you next time. God bless.